And on today's show, how 2 key planning strategies can transfer huge amounts of wealth with the least amount of taxes. Part 3 of this week's series on estate planning update for 2015 with author and top producer Mike Kilborn, CLU CHFC. Hi everyone, I'm Steve Savant, syndicated financial columnist and contributing author to InsMark, LifeSpecs, and Backroom Technician. Let's get down to business. Well, welcome to the show, Mike. Day 3.
Yeah,
I love this. Well, we're talking with Mike because not only is he a top-of-the-table producer, and he plays with some of the most affluent and some even uber-affluent Americans as his client base, he really does a great job of identifying issues, and here's 2 today. We're going to talk about 2 key issues. If you can learn these 2 issues, this could be huge for your practice.
Well, these are strategies to help the wealthy pass assets with the least amount of tax possible. And the first one is called a Grantor Retained Annuity Trust, or a GRAT. And you hear that term, you don't know what it means, but it's pretty simple. And basically, you provides a way to make gifts of property to heirs while retaining an income interest for a period of years. So we get to reduce the value of the gift of the money transferred by the present value of the income stream that you're expecting to receive back. And that's the primary reason to do it. Now, what we want to do is make sure that the GRAT earns it's in the trust, earns a return that's greater than the government's rates. And the government's rates are so low right now that that's sort of easy if you have any kind of good asset that you're passing.
I think you told me in one time it was 2 point something?
Yeah, actually the midterm rate's 1.89, but the 75-20 rate is 120% of that, so that's 2.2%. I mean, if you've got, let's say, a piece of real estate that's throwing off 10% cash flow, plus it's appreciating at 5 or 10% a year, I mean, those are...
That's ideal.
That's a great asset. So at the end of the day, whatever's left over the period of time that you get your income, your annuity, the asset goes to the heirs, and it's basically, if we do it right, zeroed out, we can have no tax. We can have some tax or no tax. We can actually design it. It depends on the period of years we pick. It depends on the government's rate. It depends on the payout. And so we would design it so it ends up being what we call a zeroed out GRAT.
And this is flexible enough that you may make modifications every year.
Well, you can design it to be short-term GRATs and keep making new GRATs, but you don't change the rates and stuff in the GRAT itself.
Okay.
And it's a wonderful tool. But think about it. You're basically getting back what you put in, but the growth is passing on to the heirs. That's the kind of the primary purpose of a GRAT. And so there's another comparative method that's called an intentionally defective grantor irrevocable trust. Now, that's hard to say. I call it an IDGIT. And basically, in 1954, Congress devised certain rules thinking that no sensible taxpayer would want to pay a trust tax bill, especially because individual tax rates were higher than for trusts. So, I mean, back then, like 70%. And what you had back in the 1950s was something called a Clifford Trust. You could put assets in it for a period of like 10 years, and then you get it back. But in the meantime, all the earnings were not taxed at your rate. They were taxed to the trust or the beneficiaries. Those were kind of things that the IRS didn't like. So they created a bunch of rules. And if you did these things, they automatically had it taxed to you. But now today, with the low tax rates, we actually want to pay the tax for the trust. So if you put these certain things, code 671 through 678, say, for example, you put wording in there that says that you can substitute assets. Maybe you put a piece of real estate in and take stock out and transfer assets in the trust. I mean, it doesn't have any real effect, but for purposes of making it a grantor trust, it does. And so what we've done is create a way for you to pay the income tax on the trust, so the trust doesn't have to do it itself. Well, think about that. That's a wonderful gift. And yet the IRS has ruled that it does not create a gift, which is another important ingredient.
You're still paying the tax, but at the trust rate. Is that correct?
You're paying the tax, yes, at the income, just as though it was in your income. It never left your income. It never left what you had on your tax return. You've moved the asset in, but you continue to pay the tax on it. And again, some people say, well, that might be a bad thing. Well, you can put a wording in that trust to be able to flip it so that maybe now the trust does pay its own tax and you no longer have to pay it. Maybe it sells a big asset and has a huge tax and you don't want to pay that. So a good attorney will put the proper wording in there. But this is a wonderful way to basically give assets away. Now, we're not going to get them back, but I'll tell you in the next segment, we'll talk about a way to do like the GRAT, Grantor Retained Annuity Trust, and have income coming back to us.
Now, when I'm looking at these two ideas are major pillars in planning when you're talking about estate planning. And I'm trying to think about how many people deploy these two strategies in their practice when they're dealing with people that have a sizable estate, especially. And when you're in your experience, you see people who've already done some planning, and it comes to your table. Do you see these two, any one of these two, missing?
Well, I see them brought up in many, in the higher level. Yeah, I see these brought up in almost every case. And between the two, I lean towards the intentionally defective grantor irrevocable trust.
It almost sounds illegal. You're intentionally defective,
Well, it's intentionally made so that I pay the tax for the trust. That's a defective part. So we call it grantor. So when you hear the grantor, that automatically, grantor trust, that means you are going to pay the tax for the trust, the asset, the entity.
We get back from the break. We're going to continue more on this, and we're going to have you explain this whole thing. We'll put it up on the Mondo pad here and walk us through the pictorial. We'll be right back after the break. It's not how much money you make for your clients, it's how much money they get to keep, especially in retirement. But retirement income could cause Social Security benefits to be taxed. One tax advantage alternative is life insurance designed as a non-modified endowment contract that can generate tax-free income without taxing Social Security benefits. These contracts offer differing funding options depending upon your client's risk tolerance. For more information on how life insurance can be part of your retirement planning, just email me at steve@downtobusiness.tv. Brought to you by Ash Brokerage, the practice enhancement company. Well, welcome back to our second segment. Of course, we're with Mike Kilborn, CLU CHFC, and author of Disinherit the IRS, which is out on disinherittheirs.com, and you can buy it on Amazon.
Disinherittheirs.com, Amazon, and Barnes & Noble.
Barnes & Noble. Yeah. The reason I like this book is because I like so much of the knowledge that we're talking about all this week is in this book, and it's in English, easy to understand. If you want to start dipping your toe as an advisor into this realm where Mike's been playing for 20 plus years, I mean more than that, probably 30 years, where you'll want to use this book as your hand guide, and I like what you did at the back end. Sometimes I get lost in the definitions, I just have to admit it. Right. I love the glossary. The vocabulary is great, and it walks you through it. And talking about vocabulary, we're going to walk you through some of this now. Now, I noticed some people actually use the acronym IDIT, right?
Or IDIT, yeah.
IDIT. But most of if we have any consumers having to watch the show, again, it's a irrevocable, right?
Intentionally defective.
Intentionally defective grantor trust. Got it.
Intentionally defective and grantor means the same thing. So you could take out intentionally defective, just say grantor trust, and you're there.
Well, walk me down the perks of this. Why this is such a powerful thing.
All right. Well, so in the last session we talked about the intentionally defective trust, but now we're going to talk about selling an asset to the trust. So something's coming back like the GRAT, and only this is a better alternative for a number of reasons. So let me just give you some benefits, and then we'll talk about a diagram I've got here. So first, it reduces the need to use any gift or estate tax exemptions because you're selling an asset to it and getting something back. Secondly, the IDIT grows without income tax. Grantor, that's you, this is a grantor trust, pays the income tax. Third, it freezes the value of the asset. So if you're getting back the asset you sold it, while it was in there, it was growing, and the growth stays in the trust. It freezes, you get the asset back. Or it can discount or shrink the value of the asset. So when you get something paid back to you, it's actually less paid back. So some of the principal stays in the trust along with the growth that's already in there. I love that one, and that's going to be our diagram.
Okay.
And then it avoids the capital gains tax. So I can sell an asset to the trust. Now get this, to my intentionally defective grantor trust, because it's a grantor trust, there's no capital gains tax. I bet people love that one, and my clients love that. I mean, now we're talking, and next, with the interest payments that are coming out of it to me yearly at some rate, perhaps now with low rates, you don't have to make money on your family, you could pay one of the low rates. There's no tax due on the interest payments back to you because you're already paying the tax on the trust income. And then it leverages the generation skipping transfer tax exemption. If we say that this trust will last for your kids, your grandkids, and beyond, then we're skipping Uncle Sam at each generation. We call that generation skipping. Well, in my book, I call it IRS skipping because that's what it actually is. And it magnifies the value of the trust possibly by millions of dollars for years, and it disinherits the IRS in Florida, it's 360 years you can disinherit them for. In some states, it's forever, into perpetuity. So let's look at the diagram. Basically, we start out we make a sale, but I'm going to discount. I'm going to take an asset. Maybe it's some real estate. I'm going to put it in a family limited liability company, or a family limited partnership, either one. And then I'm going to sell not so much the real estate as the limited partnership shares. Now, I remain in control just by having the family limited liability company right there. I control the asset, but now it's into the intentionally defective trust. And from there, Well, we're going to get a payment back. And by the way, before I do that, I am going to make one gift to the trust. To make this work, we want to give the trust some viability. So typically we say, if you're going to sell $1 million asset, let's make a gift of 10%. So that might be a $100,000 asset goes into the trust as a gift, okay? And we'll use our exemptions to get it in there, both our gift tax exemption and our generation skipping tax exemption. So this trust could last for a lifetime. If it grows to $1 billion, it's still no gift tax, no generation skipping tax.
Wow.
So, so now we have family limited partnerships here, and payments. Interest is going to be paid back, and we're going to use the midterm rate. We'll make it a 9-year note. Midterm rate right now happens to be 1.89%. Think about it. This trust, this real estate, let's say, is producing a 10% cash flow. So and that stays in the trust. And at the end of 9 years, Rule 72, let's say this doubles. So it only has to go at 8% a year in value, and it doubles at the end of 9 years. So now I've got twice the asset I put in, but I'm only going to pay myself back not the original amount, but something less because I got a discount. Maybe it's a quarter of the what now value. And in the meantime, I might take some of the income and buy an insurance policy. Talk about leverage. And at the end of the day, the heirs end up with some huge amount of asset. The original asset discounted, growth, less the payback, plus a life insurance. I mean, if I did numbers to this, you probably wouldn't even believe them. I mean, we're talking tens of millions of dollars can be created through this arrangement.
Now, how many docs? Am I counting this right? You have 2 docs here then?
Well, we have the family limited partnership.
And they have shares, so they're going to sell shares too.
And we put the shares, so the family then sells the share, the parents sell the shares to this intentionally defective grantor irrevocable trust.
Now, you still said, you kind of threw something there. I was with you until you said the issue of, now I'm also going to maybe use some gift tax or exemption.
Well, I'm going to make a gift, I'm going to make a little bit of gift in the beginning to make this thing viable. And all the experts say maybe about 10% of my intended value of the sale I'm going to make. And so if it's about $1 million asset, maybe I'd put $100,000 in. If it's a $10 million asset, maybe I would gift 10%, $1 million. And I'd use some of my exemptions to get it in there. My exemption for gift and my exemption for generation skipping, so that this trust now is cleansed of tax, all tax, through as many generations as your state allows it to go.
Well, sometime if we ever do a workshop, I want to see what that number is, because I know it's huge.
This is powerful.
As big as it gets. Well, that's all the time we have for today. Remember, before moving forward with any of the ideas on our show, always consult your tax advisor, legal counsel, or your broker-dealer compliance officer. Missed an episode? Just hop out to our video archives. And remember, you could be wiser as an educated advisor. I'm Steve Savant. We'll see you tomorrow.